Dick's Sporting Goods, NYSE, DKS, today reported strong fourth quarter and full year 2025 results for its core business, but issued weaker-than-expected profit guidance for fiscal 2026 as the company continues to absorb significant integration costs and restructuring charges related to its $2.5 billion acquisition of Foot Locker, completed in September 2025. The sporting goods retailer delivered record-setting fourth-quarter sales for the Dick's business, with comparable sales growth of 3.1% in Q4 and 4.5% for the full year 2025, driven by higher average ticket and transaction volume. Full year 2025 GAAP earnings per diluted share came in at $9.97, while non-GAAP EPS reached $13.20, or $14.58 for the Dick's business alone, excluding the Foot Locker acquisition impact. However, the outlook for 2026 reflects the substantial costs associated with turning around the struggling Foot Locker business. Dick's expects full year 2026 consolidated net sales of $22.1 to $22.4 billion and consolidated GAAP EPS in the range of $13.70, $14.70, or $13.50, $14.50 on a non-GAAP basis. This guidance falls below some analyst expectations and reflects the ongoing drag from the Foot Locker integration. The company disclosed that it expects pre-tax charges of $500 to $750 million in 2026 related to unproductive asset reviews, merger and integration costs, and deferred financing amortization. This includes $235.5 million already recorded in Q4 2025 to write down and liquidate Foot Locker inventory, plus additional merger and integration expenses. The acquisition has also significantly impacted the balance sheet, with inventories ballooning 47% to $4.9 billion, including $1.5 billion from Foot Locker, and long-term debt and lease obligations rising 28% to $1.905 billion. Dick's management emphasized that the core Dick's business remains strong, projecting comparable sales growth of 2.0% to 4.0% for 2026. However, the Foot Locker business is expected to deliver pro forma comparable sales growth of just 1% to 3.0% as the company works through its turnaround strategy, which includes optimizing inventory, closing underperforming stores, and right-sizing assets that don't align with the go-forward vision. Despite the near-term headwinds, CEO Lauren Hobart expressed confidence in the long-term opportunity. "We've now owned the Foot Locker business for about 6 months, and our excitement and conviction in the long-term opportunity continue to grow. We're very encouraged by what we're seeing with our Fast Break initiative and the evolution of our 11-store Foot Locker pilot, which we plan to rapidly scale in 2026. The company also announced a 3% increase in its annualized dividend to $5 per share and plans approximately $1.5 to $1.7 billion in capital expenditures for 2026 as it continues to invest in store concepts like House of Sport and Field House locations.